Everywhere you look, people are talking about whether a stock market crash is coming in 2025. Some say it's inevitable, others say it's just fear-mongering. But the truth is this: no one can predict the exact day or month a crash will happen. What we do know is that markets move in cycles. They go up, they go down, and history tells us there will always be corrections, sometimes even severe ones. The real question isn't if a crash happens, it's whether you're prepared for it. When markets are booming, it's easy to feel like nothing can go wrong. Portfolio values rise, optimism is everywhere, and people start to believe the good times will never end. But that's exactly when investors make their biggest mistakes. They take on too much risk, they ignore warning signs, and they forget the lessons of the past. Then, when the downturn finally hits, they're caught off guard, scrambling to protect what's left. That doesn't have to be you. A crash doesn't have to destroy your financial future. In fact, if you approach it the right way, it can actually make you stronger. It can be the moment where you protect your wealth, position yourself for growth, investment, and even take advantage of opportunities that only come around during downturns. Today, I want to break down exactly how to do that. We're going to look at why crashes happen so you can stay calm instead of panicking. How to diversify your money so you're not overly exposed, why liquidity and emergency funds are your best shield, and finally, how to actually turn a crash into a wealth-building opportunity. By the end, investment, you'll have a roadmap that prepares you for whatever happens in 2025 without fear, without panic, and with the confidence to know your money is protected. When people here talk about a stock market crash, the first instinct is usually panic. Fear spreads faster than facts, and the natural reaction is to think, I need to sell everything before I lose it all. But the truth is, crashes don't come out of nowhere. They follow patterns, they have causes, investment. And when you understand those causes, you can protect yourself not by guessing, but by preparing. Investment. That's why the first step in safeguarding your money in 2025 isn't about moving money around. It's about understanding why crashes happen in the first place. Without that knowledge, every move you make will be based on fear instead of strategy. One of the main drivers of a stock market downturn is the economic cycle itself. The market doesn't move in a straight line. It goes through expansions and contractions, and these cycles are as old as markets themselves. When the economy is booming, optimism takes over, investors buy aggressively, and stock prices shoot up beyond what the fundamentals can justify. Eventually, valuations get stretched too far, and all it takes is a trigger, like rising interest rates or slowing earnings, to bring everything crashing down. If you know that the market always moves in cycles, you stop thinking in terms of if a crash will come, investment, and you start thinking in terms of when. The interest rates are another critical piece of the puzzle. In 2025, central banks are still trying to balance inflation with economic growth. When interest rates rise, and borrowing becomes more expensive for companies and consumers, that slows down business expansion, reduces corporate profits, and makes stocks less attractive compared to safer investments like bonds. Higher rates pull money out of the market, which puts downward pressure on stock prices. Understanding this connection means you don't just watch the stock market, you watch the bond market, the central bank's decisions, and the broader credit environment. These are often the leading indicators of where stocks are headed. Inflation plays its own role in this equation. When inflation is high, the cost of everything goes up: food, housing, energy, and consumers start pulling back on spending. For companies, that means higher costs and lower margins. Investors see weaker profits and they start selling shares. If inflation remains persistent, it eats away at the real returns of investments, causing even more selling pressure. On the other hand, if inflation suddenly drops, it may signal a weakening economy. Both scenarios can contribute to volatility. The point is, investment. Inflation isn't just a number you hear on the news. It directly influences how the stock market behaves. Government debt and fiscal policy also play into the likelihood of a crash. In times when governments overspend, rack up debt, or fail to manage budgets responsibly, investors lose confidence in the long-term stability of the economy. That uncertainty can cause sudden corrections in the market. For example, if investors begin to believe that debt levels are unsustainable, they might demand higher interest rates to buy government bonds, which once again puts pressure on stocks. Now, here's the thing. Most retail investors don't take time to understand any of this. They just react. They see headlines, good investment. They feel fear and they move money impulsively. That's why understanding is your first line of defense. If you know the reasons behind market movements, you won't get caught off guard. You won't be the one selling at the bottom and locking in losses. Instead, you'll have the clarity to sit back, assess the bigger picture, and make decisions that actually protect and grow your wealth. For example, think back to any past crash. In 2008, it was the housing and credit bubble that burst. In 2020, it was a global pandemic. In both cases, investors who had studied the underlying risks weren't surprised when the market collapsed. And more importantly, they weren't paralyzed when it did. They had already thought through the why and the what next. That's the position you want to be in for 2025. It's also worth remembering that the market often overacts. Investment crashes aren't just about numbers, they're about psychology. When fear spreads, selling snowballs and prices drop far below their real value. If you're one of the few people who understands the actual drivers of the downturn, you can recognize when fear has pushed prices too low. That's when opportunities appear. But if you don't understand the reasons for the crash, you won't have the confidence to buy when everyone else is panicking. So the first step to protecting your money is knowledge. Study the cycles, watch interest rates, pay attention to inflation and debt. Don't just react to headlines, understand the forces behind them. That way, investment, whether 2025 brings a full-blown crash or just increased volatility, you'll have the insight to act with logic instead of fear. And in the long run, that difference is exactly what separates people who lose everything from those who come out ahead. If there's one mistake that wipes people out during a market crash, it's having all their money tied to one type of investment. Most people put everything into stocks because that's what they hear about the most: big companies, high growth, and the chance of quick returns. The problem is when the stock market takes a dive, so does their entire portfolio. That's why diversification isn't just some fancy investing term. It's one of the most practical strategies you can use to protect your money. Think of diversification like building a financial safety net. Instead of relying on just one rope to hold you up, you've got multiple ropes tied together. If one rope snaps, you don't fall. You've still got support from the others. This is exactly how a smart portfolio works. When stocks drop, investment. Other assets like bonds, real estate, or even cash reserves can hold their value or move in the opposite direction, balancing out the losses. Let's break it down. Stocks are an important part of any portfolio. They offer growth. They can compound over time, and they give you ownership in businesses, but they're also volatile. Prices move based on earnings, economic data, interest rates, and even news headlines. When you put too much money into stocks, you expose yourself to unnecessary swings. By contrast, bonds provide stability. They don't grow as quickly, but they pay interest and often move differently than stocks. When investors get nervous and sell stocks, they usually buy bonds for safety. That's why holding both creates balance. Then you have real estate. Property works differently than financial markets because it's tied to physical assets. People always need places to live. Land is limited, and rents generate steady cash flow. In a downturn, real estate values might fall temporarily, but the income from rent usually keeps flowing. That makes it a strong hedge against stock market volatility. Investment. Cash is another overlooked piece of diversification. Most people don't think of cash as an investment because it doesn't grow. But in a crash, cash is your safety cushion. It gives you liquidity. It means you're not forced to sell assets at the bottom just to cover your expenses. Even more importantly, it gives you the power to buy when prices are cheap. Having 10-20% of your portfolio in cash or short-term safe assets might feel boring when markets are soaring, but it feels like gold when everything crashes. Some investors even add commodities like gold or silver. These have been safe havens for centuries, especially in times of inflation, currency instability, or market fear. They don't always move in the same direction as stocks, and that's exactly why they're valuable in a diversified portfolio. The key idea here is balance. No single investment should be so large in your portfolio that it can take you down if it crashes. Imagine two investors. One has 100% of their money in tech stocks. The other splits their money into stocks, bonds, real estate, and cash. When a crash hits, the first investor loses 45% overnight and panics. The second investor takes a smaller hit because while their stocks dropped, their bonds gained, their real estate kept paying rent, investment, and their cash gave them flexibility. Same crash, completely different outcome. Diversification also protects against timing risk. Nobody knows exactly when a crash will happen. Even experts get it wrong. But if your portfolio is diversified, you don't need perfect timing. You can ride out the volatility because other parts of your portfolio will help smooth the ride. That means you can stay invested for the long term without constantly worrying about the next headline. And here's the deeper truth: diversification isn't just about protecting wealth. It's about creating opportunities. If you have your money spread across different assets, investment, you're positioned to take advantage of whatever the market throws at you. Stocks may fall, but maybe bonds rally. Real estate might dip, but rental income still comes in. Cash might look boring today, investment, but tomorrow it could buy undervalued assets at bargain prices. What you're doing is shifting from being reactive to being proactive. Instead of panicking when the stock market moves, you're already prepared because your portfolio isn't tied to just one outcome. You're protected in the short term, and you're set up to grow in the long term. So as you think about 2025 and the possibility of a crash, ask yourself, if the market fell 30% tomorrow, what would that do to your money? If the answer is, I'd lose almost everything, then you're not diversified enough. The time to fix that isn't during a crash. It's before it happens. By spreading your investments across different areas, you're not just avoiding disaster, you're building resilience. And resilience is what keeps your financial future intact, no matter what the market does next. One of the most overlooked parts of financial planning, especially when people think about market crashes, is liquidity. Everyone wants to talk about stocks, real estate, or bonds, but very few people focus on the importance of having money that's immediately available. Yet liquidity, combined with a strong emergency fund, is what actually separates those who survive market downturns from those who get wiped out. In fact, investment, it's not always the crash itself that destroys investors. It's the fact that they didn't have enough liquid cash to keep themselves afloat, and that forced them into terrible financial decisions at the worst possible time. Think about this. Investment. When the market drops suddenly, your portfolio value may look like it's cut in half. But here's the real danger. If you don't have cash to pay your bills, your mortgage, or unexpected expenses, you'll have no choice but to sell your investments to cover those needs. That means you're locking in losses. You're selling at the exact bottom when everyone else is panicking. And that one decision can set you back years, even decades. This is why liquidity isn't just a nice to have. It's a critical shield against financial disaster. And emergency fund is the foundation of this shield. Ideally, you should have 6 to 12 months of living expenses in cash or cash equivalent assets. That way, even if you lose your job during a recession or the market crashes and your portfolio value drops, you're not forced to touch your investments. You've got breathing room. You can wait for the recovery instead of selling in desperation. Now, some people argue that keeping so much money in cash is a waste. After all, cash doesn't earn much, and inflation eats away at its value over time. But here's the thing, the purpose of an emergency fund isn't growth, it's stability. It's not there to make you rich, it's there to keep you from going broke. Think of it like insurance. You don't complain that your car insurance doesn't make you money. You value it because it protects you when something goes wrong. An emergency fund works exactly the same way. Liquidity also goes beyond just an emergency fund. It's about making sure a portion of your investments are in assets you can access quickly without massive penalties or losses. Real estate, for example, can be a great investment, but it's not liquid. If the market crashes and you need cash, investment. Selling a property isn't easy. It takes time, and you might be forced to sell at a discount. Stocks are more liquid, but selling them in a downturn can mean realizing big losses. That's why having a healthy allocation in cash or short-term safe assets like money market funds or short-term treasuries gives you flexibility. This flexibility is priceless during uncertain times. Imagine two people in a downturn. Investment. The first has all their money tied up in real estate and stocks. The second has stocks, bonds, real estate, plus a year of expenses sitting in cash. When the crash comes, the first person has no choice but to sell at the bottom to survive. The second person doesn't sell anything. They use their cash buffer, wait for the storm to pass, and when the market bottoms out, they actually buy more assets at a discount. The first person locks in losses. Investment. The second person positions themselves for gains. Same crash, completely different outcomes. There's also a psychological benefit to liquidity. Crashes create panic, and panic leads to bad decisions. But when you know you have a solid emergency fund and accessible cash, you're not as easily shaken. You don't wake up every morning in fear of what the market did overnight. You know that no matter how bad things get, investment, your basic needs are covered. That peace of mind is what allows you to think clearly and make smart financial moves while everyone else is acting out of fear. Another point to consider is job security during a downturn. Recessions often bring layoffs. If your income suddenly stops and you don't have a cushion, you'll be scrambling. That's when credit card debt and personal loans start piling up, digging an even deeper hole. But with a strong emergency fund, you buy yourself time. Time to find a new job, time to adjust your budget, and time to let the market recover. It's easy to ignore liquidity when times are good. When the market is going up and your portfolio is growing, investment. The temptation is to put every dollar to work. Nobody likes seeing cash just sitting there. But crashes remind us why that cash matters. It's not wasted, it's strategic. It's the safety net that prevents small setbacks from turning into financial disasters. So as you prepare for 2025 and the possibility of a market downturn, ask yourself, do you have enough liquidity to survive 6 to 12 months without selling investments? Do you have a safety buffer that allows you to sleep at night knowing you won't have to panic, sell when the market is down? If the answer is no, investment, then building liquidity should be your top priority right now. Because no matter how smart your investment strategy is, it won't matter if you're forced to sell at the worst possible time. Liquidity gives you control. And control is exactly what you need when the rest of the market is losing its mind. Most people hear the word crash and instantly think disaster. They picture portfolios cut in half, retirement savings vanishing, and years of hard work disappearing overnight. But here's the truth: while crashes are painful, they also create the biggest opportunities in investing. The difference lies in preparation. If you're unprepared, a crash feels like the end of the world. If you're prepared, it's a once-in-a-decade chance to build wealth at a discount. Investment, positioning yourself to take advantage of a downturn, isn't about luck. It's about having a clear plan before it happens. The first step in turning a crash into an opportunity is shifting how you view them. Instead of looking at a crash as something to avoid at all costs, start seeing it as a sale. Think about it: you don't get upset when your favorite store runs a 50% off sale. You line up to buy more. Yet when the stock market goes on sale, most people panic and run away. That's backward thinking. The key is to recognize that temporary drops in value don't destroy good investments. A great company selling for half price is still a great company. If anything, it's a better deal. Of course, the only way you can take advantage of that sale is if you've prepared in advance. This is where the liquidity and diversification we talked about earlier come into play. If all your money is tied up or you've over-leveraged yourself, you won't be able to buy when prices are down. You'll be stuck watching from the sidelines. But if you've built cash reserves and kept your financial house in order, you'll be ready to strike. Let's say the market drops 30%. For most investors, that feels catastrophic. But for the prepared investor, it's an opportunity to scoop up assets that were previously overpriced. A stock trading at 100 is now at 70. A rental property that seemed too expensive last year is suddenly selling for a fraction less. Bond yields may rise, offering safer returns than before. None of this is possible if you're scrambling for money during the crash. But with a plan, these moments can become wealth-building events. The next step is knowing what to buy. Not every asset that drops in a crash is worth owning. Man, some businesses fail during recessions, and some investments never recover. That's why preparation isn't just about having money. It's about having a watch list of quality assets you'd love to own at the right price. These might be companies with strong balance sheets, reliable cash flows, or competitive advantages that allow them to survive downturns. It might be real estate in markets with strong demand and limited supply. The point is, and you don't want to wait until panic sets in to decide what to buy. Make that list now, so when the crash happens, you can move with confidence while others are frozen in fear. There's also a psychological advantage to being prepared. Crashes test your emotions. They create doubt and fear, and they make you second guess every move. But when you have a plan in place, cash reserves, a diversified portfolio, and a list of target investments, you're not reacting emotionally. You're following a strategy. That clarity allows you to act rationally while the majority of people are acting irrationally. And historically, it's those who stay calm and calculated during downturns that come out far ahead. It's important to note that you don't need to predict the exact timing of a crash to benefit from it. Nobody can perfectly call the top or the bottom of the market. What you can do is be ready for volatility. That means consistently setting aside cash, consistently reviewing your portfolio, and consistently keeping an eye on opportunities. If you're always prepared, investment, the timing won't matter. You'll be in a position to take advantage whenever the market does fall. And here's where long-term thinking really pays off. After every major crash in history, the market has recovered. It might take months, but it might take years, but recovery always comes. Those who panicked and sold during the downturn missed the rebound. Those who stayed the course, or even better, bought during the lows, saw their wealth multiply. Investment. The difference wasn't intelligence. It wasn't timing. It was preparation and discipline. So ask yourself, if the market were to crash tomorrow, would you be one of the people panicking, or would you be one of the people buying? If you're honest and realize you'd probably panic, then now is the time to prepare. Build your liquidity, diversify your portfolio, make your watch list of assets you believe in long term. Because when the market does fall, it won't feel like the end of the world. It will feel like the chance of a lifetime. Investment. The ultimate way to protect your money in 2025 isn't to run from crashes. It's to be positioned so that a crash doesn't just leave you unharmed, but actually makes you stronger. Because while most people will look back and say, I lost everything, the prepared investor will look back and say, that was the moment I built my future.